Government shutdown, day 36. No economic data. We're trading in the cloud. Our call, buy the cloud. At first glance, there seems to be some confusion between stocks and bonds, but we're going to show you it makes perfect sense. To set this up, let's begin with the Fed funds futures. This is the December contract, showing the probabilities the Fed will not cut rates. What's very clear is the odds of a no cut spiked in October from single digits to around 30% currently. What happened that day? We're going to show you. Stock markets have certainly picked their direction. From their all time highs, all major stock indices are down, almost with no reprieve. Meanwhile, Treasury yields are moving in the opposite fashion, with short term 13-week yields surging from 372 to 380 and longer term 30-year yields rallying from 455 to 470. In yellow, that's a short term 13-week Treasury. In blue, long term 30-year. Over the past week, both yields have surged. Keep in mind, short term notes move in anticipation of future interest rate decisions, while long term bonds move based on the prospects of economic growth and inflation. So essentially, what we're seeing here is weakness in stocks as bond yields move higher, as the hopes of another Fed cut in December begin to diminish. This makes perfect sense, and corporate profits and stock prices tend to perform better under low interest rate environments. Let's consider the net flow of funds in the month of October. The message behind the data is quite telling. There's definitely a change of hands, with investment capital moving from certain asset classes to others. In the month of October, 800 million moved into XLU, an exchange traded fund focused on utility stocks. This is a defensive play. 1.3 billion into XLV, that's healthcare, another defensive play, and 187 million flowing into XME, metals and mining. Think of the huge gains in gold and silver. Of course, investment capital continues to chase one particular technology sector. We're talking about semiconductors, widely held in XSD, which received $103 million of new money. Regarding the defensive plays, we've created a basket of healthcare, utilities, and staples, which collectively received over $2 billion in new investments. The markets certainly have adopted a cautious tone. More buyers are flocking into biotech, XBI, to the tune of 438 million, and 45 million into XES, that's oil and gas. What you'll notice is the buyers have become very particular. We don't see aggressive investments in retail, broad-based cyclicals, or consumer discretionary. This is not what a healthy economy looks like. And there's also been selling pressure in XHB, that's home builders, which lost over $230 million this month. Why is all this happening? Well, according to Reuters, the Fed has added a wrinkle to the equation. Investors were pinning hopes on more monetary policy easing ahead, even as Wednesday's Federal Reserve meeting revealed a less certain path towards more interest rate cuts in the face of a data drought, sticky inflation, and divided opinions among the central bank's members. Federal Reserve Chairman Jerome Powell surprised markets by casting doubt on the prospects of an interest rate cut at the central bank's next meeting in December, saying such a move was, quote, not a foregone conclusion, even though markets had priced it in as an almost done deal. As a result, Wall Street erased gains in stocks and bonds sold off, sending yields higher. But there's a strong case to be made for the bulls, and it's standing right in front of us. This is the VIX, the volatility index, also known as the fear index. It's based on the premiums on the near-term options on the S&P 500. When stocks go down, the VIX goes up. True, we did spike up to 19 the other day, but that's still relatively low. And very quickly, the VIX has settled back down to the 17 handle. This does not look like a market gripped in fear. In fact, during this entire market sell-off, the VIX hasn't moved at all. If we didn't know anything about what was happening in the stock market while watching bond yields soar, we would logically conclude all is well. Traders in the market are overall just not pricing in any type of significant risk. Amazing the stock market has gone down apparently simply due to lack of data. Remember those Fed funds futures spiking after the last Fed meeting? The idea is the Fed should cut rates and most likely will cut rates, but they're just hesitant to do so during the government shutdown with a lack of economic data. My prediction? A Fed cut's still coming. The Fed just can't say as much for now. but not forever. Let us know what you think. Did we get this right? Also, join us on Substack, link in the description. We thank you for joining us. We look forward to seeing you back soon.